This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 345 was produced on October 13th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. We've got a longer than usual show lined up for you this week, but it's a good one. First, I'll have an update on our recent uranium episode. Then Tressis chief economist Daniel Lacalle returns as this week's feature interview guest. Folks, we really are looking for experts who disagree with me about how bad the macro outlook is, particularly in Europe. But I'm afraid you're not going to hear much disagreement from Daniel Lacalle, who says the dire economic situation in Europe is entirely the making of EU policymakers, not Vladimir Putin.
And I'm Patrick Serezna. Listeners, be sure to stay tuned for our post-game segment after Eric's feature interview with Daniel Lacalle when Eric, Nick, and I discuss the S&P 500's reaction to inflation numbers and touch on the technicals on oil, gold, and the dollar. Now, Eric, before we move on to the feature interview with Daniel, let's cover crude oil. EIA inventory was delayed a day this week and hasn't been released when we recorded this week's podcast, so we'll skip the inventory data this week. What else is going on in the oil markets?
Patrick, the news has been coming in waves, and last week the big story, of course, was the OPEC Plus production quota cut, which most people perceived as a production cut, although that's not actually what it was, as we reported last week. This week, it seems like the China COVID is getting worse news is what's driving the market. We also had another spike down on the CPI print this morning. Now, I'm still leaning toward the bottom is in, but anything's possible with this news flow. There's also this resurrected NOPEC bill, which was passed this week. Frankly, folks, this is complete nonsense. I can't tell if they believe their own bullshit or if they're just trying to make it look like the government's doing something to be tough on Saudi Arabia into the midterm elections. The NOPEC bill has been floating around for I don't know how many years now. The essence of it is, look, we would like to be able to control what people in other countries not under our jurisdiction do. And obviously, the most basic principle of the rule of law is the concept of sovereignty, that one nation does not have any authority over what other nations do. Unless, of course, you're the United States and you think you're in charge of the entire world. And in this case, what the United States has done is passed a law saying that it is illegal for people in other countries to do things that are outside of the U.S. jurisdiction, but we're going to pass a law anyway because it sounds good and it, makes us look good into the elections. I guess that's the logic. I don't know. I think it's only going to make the situation worse. Obviously, the United States government doesn't have any authority to pass a law that says it's illegal for Saudi Arabia and Russia to cap their own production in order to manage the price of oil. So it's just a remarkable example of arrogance on the part of the American government that I fear is only going to exacerbate the animosity and difficulty that exists between various nations in this oil market. We have a situation here which is entirely the making of U.S. and European policymakers. Vladimir Putin definitely did a very bad thing when he invaded Ukraine, but the energy crisis was created by Western policy, not by Putin. I also spoke to our good friend Dr. Anas Al-Haji this week. I speculated last week that perhaps what Saudi Arabia was doing was trying to discourage China from refilling its strategic petroleum reserve. Dr. Al-Haji agrees with me that OPEC Plus is likely to manage markets in the future going forward in order to discourage other countries from making large refills of their SPR. Maybe they'll pass a law even though they have no jurisdictional authority to do so. Oh, no, that's only the U.S. government that does that. Never mind. But what Dr. Al-Haji clarified, and it made perfect sense when he said it, is actually the message to China was much simpler than that. It was just buy your oil from Russia. We're we're going to sell ours to Europe. Why should partners like Saudi Arabia and Russia compete with one another when the European Union has already sanctioned Russian oil? Why not just encourage China to buy their oil from Russia so that Saudi Arabia can sell its oil to Europe and nobody has any competition? Now, to my thinking, the real message here, and it's a very important one, is that OPEC Plus is done playing nice with the White House. The alliance between Saudi Arabia and Russia is stronger than the alliance between Saudi Arabia and the United States. And I think that can only be bullish for oil prices, but it's not being perceived that way by many market participants.
Eric, you mentioned an update on the recent uranium episode. What's the story there?
Well, Patrick, the uranium bugs in the MacroVoices community are a really tough audience. They tore me to shreds on Twitter over that Mike Alkin interview. They thought that I asked novice questions and didn't go deep enough on the uranium price cycle, which Mike Alkin has done a huge amount of research and work on. Hey, listen, guys, I'm learning, and frankly, some of you uranium guys are so into this, you forget that even our institutional listeners really need to start with the basics. A lot of us have not been paying attention to the uranium market because it's been uninvestable because of this ESG movement. I think that tide is definitely changing. I think we're going to see a lot of institutional interest in nuclear, and I think we did need to start with some fairly basic questions. But since you guys just love to analyze all things nuclear and rip their deficiencies to shreds on Twitter, I have a mission for you, because something else that came out of that interview is I was contacted by a company called Micronuclear Technology that has just this week, actually Wednesday of this week, announced their new product, a molten salt nuclear battery. Now, the principals got in touch with me after that Mike Alkin interview. The guy I'm talking to is called Richard McPherson. He's a former U.S. representative to the IAEA, that's the International Atomic Energy Administration. I thought that the pitch sounded great, but frankly, I will admit to being novice at microreactor technology, and it was interesting for me to learn that there's as many as about 70 different designs floating around for modular nuclear reactors that use various different technologies to improve on the old light water reactors that were built back in the 1970s. So what's the sales pitch? Essentially, what they're saying is this molten salt uranium reactor gives many of the same benefits that Kirk Sorensen has pushed on the liquid fluoride thorium reactor. That is, it has no circulation pump that can fail. Therefore, the whole concept of a meltdown is completely, totally impossible. It just can't fail that way, the way light water reactors can. But it still uses uranium rather than thorium as its fuel, and that's very important because there just is no regulatory structure to build thorium-powered reactors. We need to stick with uranium because that's what the government is capable of regulating and controlling. These things will be built in a factory. They're designed to have a 10-year service interval. So it's built and fueled in a factory, shipped to where it's going to be used, and then 10 years later, the replacement reactor is shipped, put into service in that same spot. The old one is removed and shipped back to the factory where it's defueled, and then that fuel is recycled in the factory. So they actually extract the uranium from the molten salt fuel that circulates in the reactor, and that allows them to minimize the amount of nuclear waste that's created by this new small modular reactor. The whole reactor is a few meters cube. It's, fits on the back of a truck, and you can ship it around on a ship and so forth. The other principals besides McPherson are Paul Murata, who seems to be the principal reactor designer, and another nuclear science guy called Richard Christensen. I don't know very much about these guys. What really fascinated me, though, about the business plan is I thought, the biggest thing for these people that are inventing these brilliant modular nuclear reactors that I think could really revolutionize nuclear power going forward. Now, the concern that I've had about these modular nuclear reactors is, it's a fantastic idea that could completely revolutionize the way that we produce energy. They're small reactors that could serve a small community and so forth. It's a brilliant idea, I think. But boy, think about the monstrous cost of dealing with the Nuclear Regulatory Commission if you're a small startup company. What these guys intend to do, and I didn't know this, apparently, if you're selling your reactors to the U.S. military, military, they're exempt from NRC oversight. They have their own military regulation or oversight over all things nuclear. And so it is possible for a small company like this, apparently, to sell these small modular nuclear reactors to the military, which has its own uranium to fuel them with. And the business model, frankly, sounds exactly like what I've always envisioned for the future of nuclear, which is build it in a factory, fuel it, send it, put it where it's going to be used, use it, send it back. So you're not building anything on site, which was where a lot of the inefficiencies came into the 1970s generation nuclear reactors. Now, I don't know squat about this stuff, as you guys so politely pointed out on Twitter after the Mike Alkin interview. So I don't know about the other 70 designs. I'm just coming up to speed on this stuff. But frankly, I thought this sounded pretty interesting. So I told Richard McPherson very directly that I would be happy to pimp his launch on MacroVoices, but to expect critical analysis and feedback from the very same uranium Gestapo that tore me to shreds on Twitter after the Alkin interview. McPherson said, bring it on. They want criticism. They want to have people look at this and tell them what they like and what they don't. So check it out, micronucleartech.com. I am not an investor in this. I just think it's a brilliant idea, and frankly, I'm trying to come up to speed and learn as much as I can about all things nuclear because I've focused entirely on crude oil. I know the future will be atomic energy. I've kind of ignored it for many years because I know that it really hasn't been investable because of the ESG movement. I do think that tide is turning, and I think it's time for smart people to learn all about all things nuclear. And as I come up to speed, I hope the people that are more up to speed will take a look at this and let us know what you think. Meanwhile, we know that you want Mike Alkin back for a more in-depth interview that gets more technical and more detailed. We'll look at a follow-up after a few months and see if we can get him back on the show.
This week's feature interview guest is Truss's chief economist, Daniel Lacalle. Eric, why did we get Daniel back on the show this week?
Well, Patrick, we have been looking for opposing views, but not from dummies. We don't want to get sell-side guys that don't know anything. We're looking mostly for buy-side analysts that know what they're talking about. And as much as we have a tremendous amount of respect for Daniel Lacalle, his views are not so opposing. I think he's very much on the same page as I am. I let this interview run long intentionally. It runs almost an hour. He was just on fire, I thought, and as we hit the usual cutoff point, I just wanted to let him continue. So we've got a longer show as a result, but I think you're going to really enjoy this interview.
Eric's interview with Daniel Lacalle is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Daniel Lacalle, chief economist for Tressis and also CEO of Alpha Strategy. Daniel, I really am looking forward to this interview. I'll tell you, I've got a very extreme view myself on the situation in Europe. I think most analysts are underestimating how bad the situation is. I think the energy crisis is set to get worse, and particularly, I think that these are self-inflicted wounds. I think that the problems Europe faces are of European policymakers' own making. Vladimir Putin did a horrible thing by invading Ukraine, but he has not caused, as far as I'm concerned, any economic problem for Europe. I think that the economic problems that Europe faces were created by misplaced and misguided sanctions that were supposedly, I guess, in theory, somebody was stupid enough to think that they were going to hurt Russia. In reality, they have hurt Europeans and Americans and only helped Russia by increasing energy prices. Please tell me I'm wrong and it's really not as bad as I think.
Thank you so much, Eric. It's a great pleasure to be here with you. And unfortunately, you're not wrong. I think that the problem in the European Union has been fully self-inflicted. The European Union was already coming from not a particularly good recovery. The recovery was much slower than that of the United States or other developed nations. Also, in terms of productivity growth, very, very poor. So that in itself was a bad start. But when the Ukraine crisis started, the European Union seemed to be implementing a number of measures that seemed to forget that the world exists and that that you cannot basically isolate Russia because there's an entire East to which it can continue to sell its commodities. So the sanctions that were implemented were, I think you've said the word misguided, which is completely correct, were basically implemented from a perspective of thinking that they would have no boomerang effect on the European Union, which was a mistake. And second, that they would have a massive impact on the Russian economy without any outlet or without any improvement coming from higher demand from Asia, China, India, etc. So basically, most of the measures were implemented believing that the European Union could have some sort of a policy change that would make it inevitable for the Russian economy to collapse and without any impact or any significant impact on the European economy. More importantly, when the European Union decided to implement restrictions and measures against Russia in terms of natural gas, what I find absolutely amazing is that they didn't look at the reality of the supply and demand situation in the European Union because the European Union cannot offset the loss of natural gas supplies from Russia. It's the so-called dependency on Russian natural gas was a political decision, and it cannot be changed from one day to another, even less so with renewables. So the problem in the European Union right now is massively high energy prices for any U.S. citizen. I just came back from Arizona, and for any U.S. citizen, the prices that we pay for energy are not even something that they would even think of in their worst nightmare. But not just the price of energy, is that the economic slowdown was already evident before the Ukraine crisis, that the policies implemented after COVID-19 were actually very negative for growth, and that the European Union doesn't have the technology advantage that China or the United States have in order to cement a different type of future. So it's a very difficult situation. It's much worse than what people perceive. When I see some of the macroeconomic estimates for the European Union for 2022, and particularly for 2023, they are clearly ignoring that this is not a winter problem. This is a long-term problem.
I just want to insert a note here for our listeners. Folks, please notice the more smart guys we get on the show, the more that I try to challenge them with, hey, look, I admittedly have crazy views. I know they sound really extreme. Tell me why I'm wrong. And you listen to a Dr. Anas Al-Haji, expert on energy, say, no, it's actually worse than you think, Eric. I told Dr. Pippa Malmgren, who worked in the White House as a presidential advisor, what should I make of another guest telling me that World War III is coming? And she says, did you read my post saying World War III has already begun? Now, Daniel Lacalle is clearly an expert macro guy in Europe, saying the same thing I'm saying, which is the situation is worse than most people think. Sorry, Daniel, I just wanted to really get our listeners thinking about the trend here, because you're not the first really smart MacroVoices guest to say the situation is worse than the consensus seems to understand. Let's talk about this energy crisis and how we got here, because honestly, I don't get it. You had on television, you had even George Soros saying, look, oil is fungible. You can't try to restrict, it's not going to work. It doesn't make sense to me, or I guess what I'm trying to figure out is it actually possible that European policymakers are stupid enough in the face of plenty of advice that these sanctions were ill-conceived and were going to boomerang? Were they just virtue signaling, trying to make their constituents make it look like they were doing something? Or do you think that EU policymakers were actually foolish enough to believe that these sanctions were going to work?
It's a great question, because obviously it's very difficult to know, but I think that there were a number of telltale signs that showed that they actually thought that they were going to work and that China would come and join them. So pretty much like with energy policy, European Union leaders thought that if they started very aggressive sanctions, the United States would obviously join, the UK, which is not in the European Union now, would also join. But I think that they were in some way certainly foolish to think that China, India, and other countries would also join those sanctions. And I think that was the big mistake, because you can implement sanctions. You can implement financial sanctions against individuals, against companies, and one can understand that. But you cannot just make a very aggressive bet on an important subject such as energy without having enough ammo to defend your position. And the European Union decided to make a very aggressive bet against an energy giant like Russia is, without having the ways to combat that position with enough domestic and foreign support. And I think that this was clearly and it comes also from a very political view about energy, which is the following. Many European leaders actually believe that you can simply switch off natural gas and oil consumption and start using wind and solar, and that everything is going to be exactly the same. Well, it is not. Wind and solar are great, but they're intermittent and they're volatile and they're unplannable. So it's impossible to offset baseload energies, baseload technologies, nuclear, natural gas, oil, etc., and think that everything is going to be solved by renewables, but even less so with the way in which the energy matrix is constructed in the European Union. So that was clearly a problem. The other problem, I think, is that many European Union leaders believed this war was going to be a very short one. So they thought that implementing sanctions without really knowing what side effects or what negative effects that would have on the European Union economy would have a devastating enough impact on Russia to stop the war by June. Because a lot of people that I've spoken with and politicians, etc., were absolutely convinced that by June everything would have ended. Obviously, that was not the case. Obviously, that was a very optimistic view about the Ukraine crisis, and certainly now it's very, very difficult to change that policy, because politicians, as you very well know, once they've implemented a policy, they will do anything to defend it, even if it has proven to be incorrect.
Well, let's really dig into that last point because, as you said, I agree with you that it seems that they badly misjudged the response of other countries, particularly China and so forth. But, I don't see any evidence that they've learned any lesson from this. Even now, with the situation, even after the Nord Stream pipeline sabotage has occurred, you've got, I think, a serious conversation going on in Germany where there are actual grown-ups saying, well, scratch our heads. Maybe we should extend the life of our nuclear plants, but gosh, we were really committed for our green agenda to shutting them down at the end of the year. It's a tough decision. What should we do? I mean, the notion that they're even thinking about doing anything other than maximizing the use of all assets that they have seems crazy to me.
Oh, yeah.
I don't get it.
You don't get it. I don't get it. As I said, I just came from a trip to Arizona. Nobody gets it there either. It's unbelievable. But I come back to the way that we started the conversation, Eric, is that it's worse than what you just mentioned. Because think about this. Germany is in the worst energy crisis ever, not seen in the First World War and the Second World War. Worst energy crisis. Okay. So obviously they've been shutting down nuclear plants throughout all of these years, and you cannot bring those back, obviously, because those are gone. However, there are 3 nuclear reactors that could still be operational, that could be working today. Yet the government puts them on standby. Think about this. The government is so stubborn, even understanding that the policy mistakes have led to this situation, that instead of saying, okay, we're going to use these nuclear reactors, let's put them to work to allow this winter and probably the next summer to be easier. They're not going to solve everything, but at least they're going to be something that is going to help. No, they put them on standby to show people that they are not backing down from their previous political decision. So that in itself is incredibly worrying. Now go to the Netherlands. You go to the Netherlands, where they have the largest natural gas field in the country. And instead of putting that natural gas field to work, investing and obviously compensating the citizens that live in the surrounding areas, because it's much cheaper than importing LNG from the United States, etc. No, they decide to continue with the phase out process of the field. So this is a clear case of politicians finding abruptly that their energy decisions have been incorrect and extremely dangerous in a situation of international crisis, and continuing soldiering on with those decisions without any change. In Spain, for example, the Spanish government, the same. They have a nuclear shutdown program. They haven't changed it. The phase out of the nuclear plants is continuing. So I come back to the point: is that they seem to be content with the idea that, okay, we will shut down demand, we will force customers to shower at colder temperatures, or not use heating. That is better than to admit that we were wrong about nuclear, that we were wrong about domestic gas. Think about this, Eric. 15 years ago, which is yesterday, the European Union produced more natural gas than what the Russian energy complex exports today. This is insane. Yet nobody is having a thoughtful discussion in the European Union, and this comes back to all the political landscape. It's not just the left or the right. It's both sides. Nobody is saying, look, we made a huge mistake. We need to develop our own resources. We need to strengthen our security of supply. We need to have all technologies working. And while we continue to invest in renewables and we continue to invest in clean energy, which is absolutely fine, we need to understand that energy policy has to be based on two things, which is affordability and security of supply. And those two pillars of energy policy have been completely abandoned and ignored by the political landscape in the European Union.
Daniel, let's talk specifically about Germany and the situation there. The way I thought this was set to go down was, okay, they're going to talk tough and we're going to get tough with Russia. Politicians say what the voters want to hear. And then when the weather gets cold, somebody's going to cave. They're going to make a deal with Russia. They're going to turn Nord Stream back on and they're going to get their gas. Then someone sabotaged the Nord Stream pipeline. Now, Senator Dick Black, the Virginia Republican who served in the U.S. Senate through 2020, has a video out this week on YouTube in which he explains his background as a former criminal prosecutor and says, look, I'm trained to think in terms of means and motive, and to do such a sophisticated attack on that pipeline, it really looks like one of two things has to be true. Either the United States did this or the United States helped someone else, such as Ukraine or Poland, do it with United States military assistance. There's even some Flight Radar 24 tracking where a bunch of U.S. military helicopters were circling over the area where the bombing of the pipeline happened before it occurred. They had traced back, the serial numbers are figured out somehow from the flight tracking data, that U.S. military had aircraft actively operating in the area before that attack occurred. What would it mean if it were proven that the United States either was responsible for this or aided and abetted someone else in blowing up the Nord Stream pipeline? It seems to me that that would permanently damage U.S.-German relations, and I think it should, frankly. I think that it puts Germany in an incredibly perilous situation. German people don't deserve to freeze to death because politicians can't seem to work out a deal. Am I missing something, or how would you interpret the implications if it turns out that the United States helped to facilitate this attack on Nord Stream?
If it's obviously proven, it's going to be a huge blow to the position that the European Union maintains with the United States. However, I think it's very unlikely that we will see a big shift in the way in which Germany and the rest of the European Union countries have, even if this piece of information was proven to be true, it would be very difficult for the European Union to radically change their position toward the United States for a very simple reason, is that the European Union decided many, many decades ago to subcontract its security to the United States, and they don't have any alternative. So there's no alternative. The real problem here is not dissimilar to the dependency on Russian gas. The dependency on Russian gas was a political decision. The German government perceived that having a strong dependency on Russian natural gas was, on the one hand, and that was absolutely true, a cheap alternative, because it was and remains the cheapest alternative in terms of energy consumption for Germany, much, much cheaper than solar and wind today. Obviously, we will see what happens in the future. And because also it was perceived that developing strong commercial relationships with Russia would facilitate an improvement in the way in which the political situation would develop in terms of the different political views of the governments, and that was a mistake. But in the case of the United States and the European Union and NATO itself, I don't think that there's any alternative. I don't think that there's any alternative because I think many years ago, I think it was President Trump, but also President Obama mentioned it, was that the position in terms of defense of most European Union countries and Germany in particular is so weak that there's no other option. So it would definitely create a gigantic diplomatic problem, but not something that could lead easily to decisive actions that would radically change the current position. So it's a very difficult one. If it is proven to be true, I can tell you that it would generate a tremendous level of discontent. But obviously, very difficult. It's a very, very difficult one to answer, to be fairly honest.
Let's talk about where this whole situation is headed in terms of Europe's future. It seems to me like the energy crisis is only set to get worse. I don't see policymakers changing direction. As you say, they're, if anything, just trying to defend their policy mistakes rather than correcting course. I predicted early in the summer that Putin would wait till October or so and turn the gas off. Turns out he did it in September. I didn't see the pipeline being taken out happening, but that's, the option to turn it back on now after negotiation has been eliminated, apparently intentionally by someone, a state actor. It seems from everything I'm hearing, it would not be possible for anyone other than a state actor to have done this attack on the pipeline. That's going to create, I'm sure, more hardship than most people realize is coming for Europe in the next 2 years. How much hardship is that? Are we talking about existential threat to the European Union and or the currency? Or are we just talking about a really bad recession? What does it mean?
It means a very bad recession. I don't think it's the end of the European Union or the currency or the euro, because I come back to the point that I made before. If you look at the political landscape from the left to the right, those are things that are not under threat, even after the elections in Italy. So that's one thing, but certainly a much, much deeper crisis than what people are estimating. We are not seeing yet the figures that are likely to soar in the next months of businesses closing because they simply cannot pay the energy bills. We have seen some examples of businesses that have gone from paying 2,000 euros a month for energy to 8,000. The average household bill has risen between 50 to 70% in natural gas, and in power around 30 to 50%. But those obviously are still figures that don't show the impact of an entire year, because those contracts, many of them are still linked to futures markets that have not been renegotiated by the suppliers. So the problem is going to start actually after the winter, because right now many households, many businesses are able to sort of survive with extremely elevated prices. And we're talking here about 3 times the price that the United States household pays in some cases. No? So one of the things that we're likely to see is that after the winter, a lot of those long-term contracts that are still informing the price that consumers are paying for their electricity or natural gas will have to be renegotiated, even at the current natural gas prices in Europe, which are at $150 a megawatt hour, more or less, and the current power prices. So that is when the problem is going to start. And the problem, again, is not a winter problem, because a winter problem is a problem of price. But we are not talking about a problem of price and supply at the same time. Right now, it's a luxury that one can afford, as Joe Cocker used to say. It's a luxury you can afford, but barely. But in the next months, what is likely to happen is that a problem of price is added to a problem of supply, because the LNG market cannot offset Russian gas for an entire year. As you know, the LNG market, the liquefied natural gas market, is extremely thin, and most of the LNG is contracted. So, what basically one can do right now, which is to import a lot more from the United States. And this is actually something that I find also ironic and fascinating about politics, is that the European Union now is the largest importer of liquefied natural gas from the United States, natural gas that is produced with fracking that is banned in the European Union. So that comes back to what we were talking about before, is that the European Union has banned the development of its own natural gas resources, while at the same time paying exorbitant amounts of money for gas produced with that same technology in the United States. However, demand in the United States is going up. Prices in the United States are high, so it's not going to be easy to accommodate the growing demand of the United States with the security of supply solution of a problem in the European Union that extends beyond this winter. Right now, storage is elevated, about 80% level of storage in most European Union countries. So that will likely support a decent level of security of supply. It seems like it's going to be a mild winter, which certainly helps. So now, in the next 3 months, it is a problem. It looks to be like it's going to be a problem of price alone. But in the following months, it'll likely be a problem of supply and price. And that means businesses closing, unemployment rising, industries leaving the European Union because they simply cannot continue to work with the elevated levels of price. And I come back to the point about politicians again, because think about this. Yes, natural gas prices soaring, electricity prices soaring, absolutely. But the average household pays about 70 to 75% of an overall bill in taxes and surcharges. So politicians haven't changed any of that, even on the face of a wave of bankruptcies in businesses and a rise in unemployment.
Let's talk about that policy response, because it seems to me that in Europe and to some extent also in the United States and in the UK, the policy response seems to be, we got a serious inflation problem. And as Joe Biden put it, you got to credit the man with the quote that I'll never forget. You don't have to worry about the inflation because we're going to pump so much money into it that it won't matter. President Biden obviously showcasing his PhD in economics from Fred Flintstone University. Liz Truss seems to be even stupider than Joe Biden when it comes to understanding inflation. They want to use subsidies, handouts, in order to solve what really is a problem where they need to focus on demand destruction. The supply is, unfortunately, they can't do anything about it. There's no choice but to bring demand down. And what they want to do is offer subsidies, reducing the financial incentive for Europeans to conserve energy. At the same time, they're talking about price controls, which you and I know is a guaranteed recipe to lead to shortages and outages, not to allow people to continue to buy unlimited supplies of anything at a price. It just guarantees that you won't be allowed to buy it at any price. It seems that all of these lessons that have been so well learned through anyone who has studied history are completely lost on the people in charge. What is it going to mean economically? It seems like inflation, I would think, would be set to maybe start to really run away, particularly in the EU, as they continue to try to stimulate their way through a problem that stimulus only worsens. Have I got it wrong?
No, you haven't. The biggest problem of the consensus estimates of inflation, which, as they always do, are rapidly estimating a decrease to around 2% by next year, is that in order to get to that level, one would need to look at the individual prices that comprise the CPI basket and think, what will it take to get to 2%? If the governments all over the world and developed nations, as you're mentioning, what they're doing to combat inflation is to spend more, increase deficit spending, which means more units of currency being issued, which means higher debt that is going to be monetized. And at the same time, the central banks of those countries are trying to quote unquote defend their currencies by selling reserves, US dollars. No? So think about this. It's almost impossible to bring down inflation in that environment. But you mentioned the concept of lessons learned, and I think that there's absolutely no lesson learned. No, when you think of what the UK government has presented for as a package of measures to combat inflation, they're all inflationary measures, but it's the same in Germany, it's the same in France, it's the same in Spain and Italy, and it's certainly the same in the United States. The government spending is driving the entire response to the crisis, government spending that is financed with higher consumption of newly created currency units. No? So I think that governments will always move to implement policies that look simple and that look easy to implement and definitive in terms of the action, but that don't work, like price controls. Price controls are the easiest thing to present to the public. They go on TV and they say, the price of food is too high. We're going to implement price controls on supermarkets. There you go. And why do they not learn those lessons that you and I, or anybody that knows anything about economics, can easily show that they don't work? First, because when they don't work, the government is never to blame. So imagine you implement price controls, supermarkets suddenly stop having the products that you require at any price, and then who do you blame? Supermarkets. The great thing...
Those greedy bastards.
Absolutely. The great thing about inflation, which is the tax on the poor, is that inflation and all of its consequences and policy responses and all of their consequences are always, the blame is always shifted to somebody else. Right now you hear, whoa, inflation. Why is there so much inflation? The blame is on Putin. The blame is on war. The blame is on China. The blame is on supply chain disruptions. The blame is on businesses. Now, Elizabeth Warren was saying that businesses were increasing their margins, even though reality shows you that is not the case. So the great thing for a politician about this horrific environment that we're living in is that they can always shift the blame to somebody else. If supermarkets don't stack up products when they impose price controls, the blame is on supermarkets. If the price of gasoline goes up, the blame is on OPEC. If the price of your rent goes up, the blame is on the landlord. So except printing money like there's no tomorrow. And the other beautiful thing for governments is that they have an absolutely endless list of economists and experts that are willing to say that the problem is everything else and anything else except printing money. Because that is another big problem. Another big problem is that you have a great deal of perverse incentives and within the expert population that know that all these things don't work, that come and because of their allegiance or their support or their work with governments, they will defend those policies. I find it amazing to see an economist like Ms. Matsukato saying that there is a great tool that we have not used yet, which is price controls. Unbelievable. Yeah?
Okay, so in Europe, we have a very dire situation, and we have European policymakers hard at work. I think you and I agree, doing everything possible to make the situation worse. I want to step back, though, and talk about where we're headed with this energy crisis, because people talk about this dire European energy crisis. Daniel, I don't think there is a European energy crisis. I think Europe is where we're seeing the first and most visible signs of a global energy crisis. And specifically, my prediction is that as China comes out of its zero COVID policy and that economy gets restarted, I think that the entire world is going to experience an energy crisis every bit as bad, if not worse, than what Europe has already seen. And the same kind of price increases that have occurred in Europe are going to hit the entire global economy. The reasons that I say that are that we simply have not made reinvestment that needs to be made in fossil fuels. Essentially, government policy is so committed to their ideological views about wind and solar that they're anxious to phase out fossil fuels before phasing in a viable replacement. And the result, because of policies that have disfavored the investment in exploration and production of oil and gas, is that we are out of spare capacity already, and I contend it is not possible for the global economy to return to pre-pandemic normal because energy supply simply does not exist to get us there. You have written books on energy and energy policy. What do you think about what I just said? Am I exaggerating? Is it really not that bad?
No, it is that bad. It is certainly that bad because when we look at the energy landscape and the picture of supply and demand, many of us tend to forget a key element that you just mentioned, which is that China's growth is severely damaged by the zero COVID policy and the shutdowns of about 30% of its GDP in the number of cities that have been in different stages of lockdown. So, so when everybody's looking at supply and demand, they're looking at a supply and demand picture in which there are big holes of uncertainty, and the recovery of China would certainly bring an elevated level of stress to that supply demand picture. Um, there's also the inevitability of what happens when you spend a decade underinvesting in energy, is that it doesn't come back quickly. And there's about 650 billion a year underinvestment in fossil fuels that is essential not just to attend the current demand, but also to maintain a flow of natural gas and oil that is enough to avoid significant shortages in the near future. And this is the first energy transition ever in history that is happening because of a political decision, not because of an industrial decision. The reason why whale oil was substituted by crude oil was because it was cheaper, easier to produce, and certainly easier to transport and to store. So that led to a massive energy revolution. The reason why natural gas became an important and absolutely critical substitute to coal was, again, for the same reason, because it was industrially viable, easier to transport, easier to store, and cheaper to produce. So all these factors have been forgotten in the political decision that wind and solar are the only options that can be thought about, which starts, like all political decisions, by ignoring the mining aspect of wind and solar, the requirements of copper, of rare earths, of aluminum, etc., etc., etc. The problem, therefore, is that as the world, developed nations, shift the energy mix to a larger proportion that is based on technologies that are volatile and intermittent, the cost of the system rises dramatically because you need backup, because you need much higher levels of investment in distribution, networks, etc. And obviously, because being intermittent, you need to have 2-3 times more available capacity for the same level of production. So natural gas was sort of the gel that kept all of this more or less in an acceptable level for the consumer until the percentage of intermittent and volatile technologies becomes too large, and therefore not even natural gas works as the gel to that process of transition. And everyone can talk about batteries and different storage options for renewables, but those are way far from where we are today in terms of industrially available options. And certainly, we are not even discussing the mining aspect and the level of dependency on other commodities that would require fundamentally copper, but also as I mentioned before, rare earths and so many others, lithium, etc. So it's a very difficult process, and it's a very difficult process only because it's pre-designed politically. Because this process would happen whenever it has to happen, when technology, industry, competition, and innovation provide the solutions. But when the solution is predetermined by a political decision and excludes every other, it is basically putting brakes on innovation. To start with, I find it almost astonishing to think that today, years and years and years after the wind and solar have started to develop, solar panels continue to be those massively inefficient and hugely consuming in terms of size and everything compared to with what they should be. Think about why our phones are smaller and more efficient and provide more services. Because competition innovation is constantly looking for solutions to things that we would not even dare to believe when I started working and I had a phone which was the size of a small piece of luggage. All of those things have happened because competition, innovation, technology have been allowed to reach the best solution for consumers. However, this transition has been politically designed, and by that, because of that, it is industrially flawed and it's extremely onerous on the consumer.
Daniel, we're talking about some really profound fundamental drivers for financial markets here. But, if there's anything that the last 10 years have taught us, it's actually the reaction of central banks to those fundamental drivers that tends to move markets more than the fundamentals themselves. So let's talk about what this means in the sense that central bankers were all kind of telling the same story, or maybe it was the same bluff of, hey, look, we've got to tighten, we got to fight inflation. We're not going to pivot. We're not going to pivot. We're not going to pivot. Oh, wait, our currency, in the case of the UK, just collapsed in the course of 2 minutes and, some huge percentage. We changed our mind. Maybe we are going to pivot. Is that coming from the rest of the central banks? Is that what we should expect? Obviously, how do you time that? It's going to move markets in a huge way. It's something that's very hard to anticipate unless you're an insider, and I'm sure there are plenty of those. Am I right to think that central banks are the right place for us as investors to be thinking about what we should be putting our attention on? And if so, okay, why don't you get your crystal ball out? Tell me what the central bankers are going to do next.
Of course they're going to pivot. Of course they're going to pivot, but we should not think that is the catalyst for markets to strengthen, because they're going to pivot reacting to something that is happening in a moment in which most central bankers, and I've had the pleasure of knowing a few of them, they're all in shock seeing markets collapse when they know that their policy is monstrously accommodative. So central bankers thought that hiking rates and explaining it well in advance and announcing it endlessly all over the place well in advance, etc., but at the same time not changing dramatically at all, in fact, the balance sheet of the central bank, continuing with reverse repo operations, continuing with liquidity injections like the central bank of England and the Bank of Japan, etc. That would be an environment that would be conducive to making investors understand that policy remains accommodative and that hiking rates is just a tool to cool down inflation. Okay? And they're in shock because they see bonds collapsing, the worst bond market since we have. I think that since we have any memory now, they're seeing pension funds losing money in nominal and in real terms. They're seeing equity markets collapse. So it's a very challenging situation for the central bank that had designed a way out to combat inflation that was clearly built to be perceived as hugely accommodative and see all investors suddenly go into panic. So that's why the pivoting is not going to work, because the pivoting comes from a non-pivoting, if that makes any sense, comes from being hugely aggressive in terms of monetary policy today. Think about the European Central Bank was showing the other day its monetary aggregates, and money supply growth in the European Union right now, in the Eurozone, sorry, is higher than what we called the Draghi bazooka in 2014. So those central bankers are thinking, why are markets collapsing when we are doing more than what Draghi said is more than enough? You see what I mean? So the problem is that the market is extremely tied, not just to loose monetary policy, which is what we have today, but to incrementally lose monetary policy at unprecedented scales. And think about this. When in 2020, central banks announced their injections, their monetary injections to combat the risk of deflation, when you have everybody in lockdown in itself is such a level of stupidity that doesn't even start to come into the radar. But that's another topic. But think about this. That there should have been already signs that they were going crazy when announcements of $1 trillion program did not generate any reaction from markets. You had to announce 10, 15, $20 trillion program. By the time the programs were 20 trillion, markets started to react. So the problem is that pivoting is not enough to come back to a process of multiple expansion that was created from nothing, that was created in a period in which we have discussed this so many times, you and I. Earnings growth was coming down. Earnings revisions were negative over and over and over, etc., etc. No, so of course they're going to pivot. And what I'm afraid is that once they pivot, and you will see it, a burst up of markets, it is very likely that markets will resume being weak afterwards, because the problem created by this monster negative carry trade against the dollar has not been solved. And it's not being solved either by the response of other central banks, which creates a higher negative carry on the US dollar.
Well, from everything we've discussed, Daniel, needless to say, we live in interesting times. But boy, where do you put the trades on here? Because there's just so many moving pieces. This is so daunting. It seems to me that you could see really, really huge volatility in either direction, depending on how a central bank policy decision happens to be made, which you have no control over or ability to anticipate. You've been in this business a long time. What do you do in this environment as an investor? What's the trade to put on here?
I think that this is an environment in which you need to look at the overall picture and think that you need to be exposed to the US dollar, that you need to be exposed to the commodity cycle, and you need to be exposed to gold and silver, which currently are underperforming in dollar terms, but are outperforming and massively in pounds, euros, yens, and other currencies. No? So I think you need to have those, which I call defense in a portfolio, in a team. You know? I also think that you need to, in terms of for the cycle, you need to be extremely aware of the risks in financials. You need to be extremely aware of the risk in what I call sectors that are so-called strategic or that have position rent, because those are going to be the ones that will be penalized by policy. So utilities, telecoms, you need to be very, very, very aware of the risk of government intervention and government restrictions in those sectors. No? And so if you stay away from financials, stay away from the retail side of utilities and the retail side of telecoms, there are plenty of good opportunities, even in technology. Everybody's looking at the NASDAQ collapse, but in technology, if we look at artificial intelligence, if we look at things that are going to drive the innovation process in the next years, companies that are generating profits today and that are generating good margins today, they're good things to look at. So, and I think that the bond route is likely to continue. So we're not exposed, we're underweight sovereign bonds and also high yield bonds. I think that those are the riskiest side of the bond spectrum. But again, I come back to the point, in investment grade, you're starting to see good opportunities in companies that have good cash flows and strong balance sheets. So, basically, I think what we need to do is to invest in those segments that are least exposed to the monetary laughing gas that we have seen in the past, which is those that need multiple expansion to justify very poor earnings and very poor margins, and those that need monetary laughing gas as well to justify yields that are completely detached from solvency and liquidity reality.
Daniel, you mentioned the U.S. dollar. I want to come back to that because a couple of weeks ago I said to our listeners on this show, look, the U.S. dollar index just took a parabolic turn up. What that usually means, what most traders will tell you, is it's time to short it because it's going to be a blow off top and probably a trend reversal. And what I said to our listeners is, yeah, that's probably the most likely case, but I'm telling you, I got a hunch in this case. We should keep a close eye on this because if it doesn't blow off, and particularly if it goes over 120, which was the high from I forget how many years ago, new all-time highs is always bullish for anything. And boy, there's a certain level, I'm not sure where it is, 120, 125, where the U.S. dollar completely breaks the entire global economy. Am I right to think that there is a level where if the U.S. dollar gets to a certain level, it is going to completely break the economy? And if so, what level is that?
I don't know what level. I know that the DXY is mostly the euro, is mostly is the dollar against the yen and the euro. And I don't see anywhere in which the Bank of Japan, the European Central Bank, the Eurozone as an economy, or Japan as an economy are likely to revert the trend that has started in terms of strengthening of the US dollar, weakening of the, which is actually not strengthening of the US dollar because the US dollar purchasing power is coming down. It's strengthening relative to others. So the problem of taking a bet against the US dollar is that you're taking a massive bet against central banks that are actually doing everything that they can to continue to debase their currency. The European Central Bank, the Bank of Japan. Even if they say that they're worried about their currency, they're actually not. Because they continue to believe the fallacy of weaker currency means more exports, which, it's, again, something that doesn't work. But in any case, the other problem is fund flows. To bet on a weakening of the US dollar, you need to bet more than on the Fed pivoting. You need to bet on the increase in dollar-based debt that has happened in the last years, plus the increase in exposure to US dollar trading, commodities, etc., to revert completely. And that is huge. Think about this. You're talking in a world that is about 90 trillion of global liquidity. You're basically making a bet that about 10% of that is going to revert out of the dollar and into weak currencies. And the way to think, and if you're betting on that, you need to think that investors globally are going to find it less risky to be in the euro, the yen, the pound, the Turkish lira, the Argentine peso, you name it, it doesn't matter, than in the US dollar, while the challenges that we talked about in energy and in the currencies of those other economies are higher than those of the United States. It makes no sense to me for a while.
Well, Daniel, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners how they can follow your work. And we do also have a large audience of both accredited and institutional investors who are qualified to invest in hedge funds. For people who want to find out what you do at Tressis, how should they contact you?
The best way to contact me is via Twitter. I have my Twitter account is at @dlacalle_IA. DLACALLE_IA. My website, dlacalle.com/EM in English. My YouTube page, Daniel Lacalle in English. So, as I always say, it's easier to find me than to avoid me. So, not a challenge to find me.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Daniel Lacalle. Now, joining us again in the post-game segment is Nick Galarnik. Now, Eric, just quickly on the interview, the coming energy crisis in Europe over the winter is obviously an incredibly important topic. But I continue to try to debate of how much of this has been priced into the market versus how much further surprise risks there are in the market that lay ahead. Anyway, what did you take away from the interview?
Well, Patrick, I already said it in the course of the interview, but I'll say it again because it's so important. I want our listeners to notice the trend here. Look, I know that I'm a very skeptical and critical guy. I sometimes am more inclined to see the glass half empty than half full, and we're trying to get people to counter that, to give the other side of the story. We're looking for really smart people who really understand macro, and what we keep finding is that they're not only agreeing with me, but they're telling me in many cases that it's actually worse than I thought, as Dr. Anas Al-Haji told me about the energy crisis. And you heard Daniel Lacalle today saying, look, the problems in Europe are entirely of European policymakers' own making. These are self-inflicted wounds, just as I've been saying here on MacroVoices. Think about Dr. Pippa Malmgren telling us World War III already began. Now, remember, she's not talking about Armageddon. She's talking about a very different kind of war. But this is a war between nuclear superpowers, and it's being fought, and it's been being fought for a couple of years now. We are living in extremely interesting times, and they're only going to get more interesting from here.
Now, listeners, you can find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Daniel's picture that says looking for the downloads. Now, let's get to these markets. Nick, the S&P 500 had a quick drop on this CPI number, which was obviously a very negative high inflation number. But we reversed it within hours and we're positive on the day. What's your take on the markets?
Yeah, that was a pretty crazy move, watching it fall to those key levels of 3,500, as I mentioned last week, which were the expected lows for the October 21st OPEX. So as I speak right now, the spot price is 36.45. And the expected move for the October 21st OPEX, which is next Friday's option expiration date, is 105 points in either direction. So that denotes a 2.88% move in either direction. The upside target there is 37.50. The downside target there is 35.40, which we breached this morning. Now, for the November 18th OPEX, which again encapsulates the midterm elections in the United States, we have an expected move of about 260 points in either direction, which denotes about a 7.1% move up or down. Upside there is 3,900. Downside there is 33.80, which is my bottom target. Put to call interest 1.63, and the IV right now of 29.1 denotes expected moves each day of about 1.8%. Now, Patrick, what are you thinking about the S&P right here?
Well, Nick, this reversal day was really interesting because a number of the technical techniques that I use were measuring moves down towards 3,400 or lower on this S&P, including on the NASDAQ down toward 10,000. But with this type of a news event and a reversal on the news, it really asked the question as to whether we see a tradable swing low. Now, I don't want in any way make it more significant than a short-term low, but whenever you see a drop and pop this way on news, it is always worth paying a little closer attention. For me, the S&P 500, the Fib zone I'm watching is just above 3,700, not much off from where the level you're looking into next week. And the way I kind of look at it is the bulls really need to clear 3,700 legitimately to actually reverse this short-term trend. If we see them still fading below 3,700, then the downside window is still open, and I'd be looking for a continuation on the downside. Anyway, Nick, you were talking about some observations on the VIX. What are you thinking here?
So this morning, looking at the VIX, when it popped on CPI numbers, we saw it push to near 34. I mentioned last week the highs usually end up being around 35, and we tapped that about 12 times this year. So we bounced off that level, and right now the spot is 32, denoting expected moves of about 2% per day in broad markets. So right now, it's important to remain cautious. Again, this rapid reversal this morning tells us that perhaps we saw a short-term bottom, but it's also possible we see new lows prior to the November midterms in the United States as well. Now on page 4, we have the US dollar index. What are your thoughts here, Eric?
Well, guys, remember a couple of weeks ago when I said, okay, blow off top is the most likely outcome, but we should also be prepared to at least think through the possibility of what it would mean if the dollar index were to continue to rise even higher. Because if that happened, the significance would be profound. Well, guess what? We're not at a new high yet, but after blowing off and retracing down to 110, we came right back up to 113 on Thursday morning. Then it came off a bit after the CPI print. Now, if this goes to new highs, and it's not looking like it right now, I'm just saying it's prudent to think this through so you know what it means when it happens, if it happens. If it goes to new highs above where it was, and particularly if it moves to above 120, let's say to 125, that means shit just got real. It means that we're going to see a major breakdown of the global economy. I am not predicting that outcome. It is an outlier. I'm just saying make sure that you're watching closely. If the dollar starts to run away to the upside from here, it means that we've got a really serious problem.
Yeah, Eric, your big picture view on the dollar, I get it. It makes a lot of sense. But one of the things that I was really looking for is whether or not the dollar index can actually continue and push on to higher highs. The interesting thing is that we're starting to see divergent price action in some of the currency markets. Shockingly, the U.S. dollar yen just continued to advance to new highs, while the Australian dollar and the Canadian dollars remain weak, making lower lows. But both the pound sterling and the euro did not make lower lows in this sequence and seem to have reversed here on the short term, and that's going to be pretty important. If the dollar index can't clear that 114, 115 high level, and we see any reversals back down below 111 next week, then we have to really ask the question whether some short to intermediate high in the dollar is in, especially if it reverses off of something like a big CPI print like this. Now, I'm not forecasting that yet, but I'm 100% watching breaks below 111, because that actually would be, in my mind, a genuine short-term risk-on signal. It could send precious metals, many commodities, and even in some part equities higher if that dollar reverses. So it's certainly going to be on my mind over the next couple of trading sessions.
So next on page 5, moving on to crude oil. Patrick, what are you thinking on this?
You know, the chart on crude oil actually is starting to be very interesting. Whenever you have such a sharp reversal like we had that got crude oil above $90, it really indicated that that dominant downtrend that that's been in place since June may be running out of downside momentum. One of the key things for me was whether or not the market was going to be able to hold above $85 on crude during this pullback. If we start seeing that dips are being bought and price action starts to hold above $90 on a sustained basis, it would be the first bullish price action we've seen in crude since the first and second quarter rallies. And so while I'm reluctant to be uber bullish yet, this price action into next week is probably some of the more important, well, at least one of the most important markets to watch.
Now, Eric, what are you thinking on gold here?
Well, our good friend Ola Hansen at Saxo Bank has a note out this week saying that they're still bullish gold, but holy cow, on the day that missiles are flying and 20 cities in Ukraine are simultaneously being decimated in a major military action, the supposed geopolitical risk hedge of choice, that's gold, was down $20 on the day. Gold just plain isn't acting like most people predicted that it would under these conditions. Now, I'm still holding my longs because I think the war situation is worse than most people understand. I do think gold eventually is going to have its day in the sun. But if the Dixie breaks 120 to the upside, look out below. The gold has really just been operating as a currency pair. And as dollar goes up, gold goes down. If dollar breaks 120 to the upside, which I do not think is likely, but if that outlier should occur, watch out below for gold.
Eric, I totally get your view on gold, but to me, gold has been and continues to simply trade as a cross currency to the US dollar. And whether or not gold's bottom is in on the short term is all about that dollar chart we were just talking about. When you look at the price of gold when it's priced in euros, or you look at the price of gold when it's priced in yen, gold continues to actually do relatively well. And as a cross currency, it's been relatively defensive, but obviously the most dominant asset has been the US dollar. And so in my mind, if we've seen some sort of a short-term high in the dollar, we could see gold hold the line here. And if we see it break above 1750 in the coming weeks, that may mean that this downtrend that's been in place since March may finally get some relief, and we might see price action get back to the 1800s. A little bit early to be bullish, but I think it's all about the dollar from here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com to start your free trial. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, a link to the chart book that we just discussed in the postgame, and a number of links to articles that we found really interesting. You'll find this and so much more in this week's Research Roundup.
That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets, and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our distributions weekly. If you've not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases, and also follow Patrick @PatrickSerezna. On behalf of myself, Eric Townsend, and Patrick Serezna, thank you for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Serezna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.